Have you ever watched one of those real estate shows
Hmm.
and you're just baffled, right? How some investors seem to move like lightning, just snapping up properties, while everyone else seems stuck wading through bank forms. Opportunities can flash by so fast, and if you're ready, well, the payoff can be huge. So today, we're going deep. We're pulling back the curtain on something you hear about more and more across the U.S. Hard money lenders. Our mission here is simple. We want to unpack what these lenders actually are, why they matter so much now, especially in these competitive markets. When does it actually make sense to use them? And, how does the whole process work? By the end, you should have a really clear picture of this fast, flexible financing option.
Okay, so let's jump right in. When we talk about hard money lenders, what are we really talking about? Is it like a bank or something else?
Yeah, that's the perfect place to start because fundamentally, no, it's not your traditional bank at all. It's usually a private individual, maybe a company, providing short-term loans. And here's the key part. They're asset-based loans.
Assets, okay.
Right. Meaning they're primarily secured by real estate.
Yeah.
So unlike your typical bank that gets, really bogged down in credit scores, income, strict underwriting rules, hard money lenders, they focus laser-like on one thing, the value of the property, the asset itself. Whether you're buying it or fixing it up, it's a really fundamental difference, changes the whole timeline.
Okay, focusing on the property, the
Yeah.
asset, less on the borrower's history.
Yeah.
That sounds like it would cut out a lot of the usual headaches, right? More flexibility.
Absolutely. And that's what's so compelling, that asset-based approach. It just opens up so much flexibility. It slashes through what people call red tape, in these really diverse, really competitive U.S. real estate markets. Speed is everything. It's often the deciding factor.
Right.
So by focusing on the property's value, not demanding, a deep dive into every corner of the borrower's finances, they just streamline the whole thing. It lets investors jump on opportunities that, well, they just wouldn't be there if they waited for a conventional loan.
So it's not just one kind of loan then? Are there different flavors of hard money for different jobs?
That's a great question. Yeah, it's definitely not one size fits all. Hard money has really evolved and meets all sorts of different investor needs now. Some common ones. Fix and flip loans, obviously. Perfect for buying, renovating, selling quickly.
Yeah.
Then you've got bridge loans. Think of them as temporary financing,
Mhm.
Bridging a gap until maybe you get long-term financing or sell the property. We also see ground-up construction loans for bigger projects, building new stuff from scratch. And something really interesting for rental properties, DSCR loans. That stands for Debt Service Coverage Ratio.
Whoa, hold on. Debt service coverage ratio. That's a bit of a mouthful. Can you break that down a bit?
Sure, yeah. So DSCR, Debt Service Coverage Ratio, it's basically just a measure, right? It measures if a property generates enough income to cover its own mortgage payments. So with a DSCR loan, the lender looks mainly at the property's cash flow, its income potential, not necessarily your personal income or tax returns, which is, a huge shift for a lot of investors. It means you can qualify based on how the asset performs.
Got it. Based on the property paying for itself.
Exactly. And then just to round it out, you've got commercial and residential hard money loans tailored for different types of properties, different strategies. It's really a broad spectrum designed for, well, a dynamic market.
Okay, that makes a lot more sense. So many options. But it still begs the question, right? Why turn to hard money when banks exist? Banks usually have lower interest rates, don't they? Sounds like there must be a catch or, a big trade-off.
You've nailed the core issue right there. The key is understanding the pain points with traditional financing. We're talking about how slow it is, the mountains of paperwork, the really strict criteria that can knock out perfectly good investors. Hard money lenders directly tackle those problems. That's why the higher interest rate can actually be a smart investment in the right situation.
So it's more than just the rate. It's what you get for that higher rate. What are those key advantages then? The things that make it worth the extra cost?
Exactly. The number one advantage, no surprise here, sheer speed. We are talking loan approvals in days, not weeks, not months, days.
Days.
Think about it. In a hot seller's market, properties get multiple offers, sometimes in hours. A traditional loan closing in 45 days, you might as well not even bother showing up. Hard money gets you in the game. It's often your ticket to entry for the best deals. Then there's the flexibility. Hard money terms can often be customized, tailored for unique deals banks wouldn't touch. Very creative solutions sometimes. And like we said, it's asset-based lending. Focus on the property, its potential. Less weight on the borrower's credit score, which, let's face it, can be a hurdle.
True.
And all that together means opportunity access. It lets investors actually compete. Grab properties in fast markets anywhere in the country. You know, there's a quote from a seasoned investor I always think of. It really highlights the value for you, the listener. They said, in today's real estate scene, the speed of closing is often more important than the interest rate. Investors who rely on hard money loans can secure properties while others are still waiting for bank approval.
That really puts it in perspective. Speed over rate sometimes.
It emphasizes that the cost of being slower can be way higher than the interest rate, especially when you miss out on a great deal.
That's such a critical point. It really frames the whole value idea.
Yeah.
But I can almost hear some listeners thinking, okay, moving fast is great, but isn't there more risk? Doesn't speed itself introduce potential problems? What are the common pitfalls?
That's a really sharp question, and it's crucial because, yes, while speed is fantastic, it's not without risks to consider. The main ones are really tied to the short repayment terms and those higher rates. So if an investor, say, miscalculates renovation time or costs blow out, or maybe the market takes an unexpected dip, they could find themselves scrambling to sell or refinance before that loan comes due. It can get tight.
Okay, so you need a solid plan B, or just a very solid plan A.
Exactly. Hard money gives you agility, but it demands really thorough homework, solid due diligence, a clear exit strategy, and frankly, a realistic view of what could go wrong. It's definitely a tool for investors who are strategic, experienced, and really know their market.
Right. So it's not for buying your forever home then. It's clear these loans aren't for every situation. They sound like they're best for specific, usually short-term needs, and those really high potential investment plays. What are some of those classic scenarios where hard money really shines?
You got it. These aren't your 30-year mortgages. Hard money excels in a few key areas. Number one, obviously, fix and flip projects. Buying low, fixing up, selling fast, classic hard money use. Then bridge financing, like we mentioned, covering that gap until your long-term funding kicks in or the property sells. Also, really vital for ground-up construction, funding new builds where traditional banks might be too slow or just too complicated. And think about auction purchases. Ever been to one?
No, but I can imagine the pressure.
It's intense. You often need cash or guaranteed financing right now. Hard money makes that possible. You can bid confidently, and then just generally any time-sensitive deals. When waiting even a week for bank approval means losing the property to someone faster.
I can just picture that auction scene. Heart pounding, needing financing in hours. That's where it's clutch, I bet.
But okay, beyond the type of project, does when you invest matter? You mentioned the U.S. market. Are there like seasonal angles where hard money is extra useful?
That's a brilliant connection. Thinking bigger picture. Because yes, it's not just the what, but the when. Especially with those distinct seasonal factors we see in U.S. real estate. Hard money lines up really well with those cycles, gives investors an edge. Take spring, for instance. That's often when the market just explodes, right? Lots of buyers, new listings everywhere.
Yeah, the spring rush.
Exactly. So if you're a flipper, you need to grab a property like yesterday to hit that prime selling window. Hard money speed isn't just nice to have, it's your strategic advantage. Lets you snatch that ideal house before someone waiting on a bank even gets their offer seen.
Okay, so it's about beating that rush. What about summer? Fall, winter? Good question. So in summer, you often see high demand for vacation rentals in certain areas. Quick financing lets investors grab those properties fast, capitalize on the peak rental season, get cash flow going almost right away. Then in the fall, the market might cool a bit. Investors are maybe thinking about year-end sales, tax strategies. Flexible hard money can be key for those last-minute strategic buys. Maybe grab something for a winter renovation. Optimize the portfolio. In winter, people think it's slow, the off-season. But that's often when you find great deals. Distressed properties pop up, sellers get motivated.
Ah, interesting. Opportunity when others aren't looking.
Precisely. Hard money gives you the agility to jump on those deals when competition might be lower. Get properties at a better price. So yeah, this seasonal adaptability is a really distinct advantage if you use this type of financing smartly.
Okay, so let's say you, our listener, are thinking, all right, this might work for me. How does it actually work? What's the process like?
Right.
From finding a property to actually getting the cash.
Well, first, always remember, short term, usually 6 to 24 months, much shorter than a regular mortgage. And again, structured around the property's value, mostly, not just your personal finances, the process itself. Pretty streamlined, usually 5 main steps. 1, find a lender. Search locally. Maybe find a trusted national company online. Ask for referrals. 2, property evaluation. This is key. The lender assesses the property, its after repair value, your plan, your exit strategy. They need confidence in the asset.
Right, because that's their security.
Exactly. 3, you nail down the loan terms. Rates, fees, loan length. It's customized to your project, your timeline. 4, approval and funding. And here's the speed again. Approvals often in days. Funds available almost right away, sometimes like 72 hours. It's fast. And 5, repayment. Typically, you make interest-only payments during the loan, then the full principal is due at the end, usually when you sell the flip or refinance into a longer-term loan.
Wow, that does sound incredibly efficient compared to the usual bank slog. But okay, the trade-off. We mentioned higher rates. How do these terms really stack up side by side with a traditional bank loan? Can you lay out that comparison clearly for us?
Yeah, let's put them head to head. This really clarifies the strategic choice you're making. Approval time. Hard money, super fast. 3 to 7 days, maybe quicker. Traditional bank, think 30 to 60 days, minimum, often longer.
Big difference.
Huge. Credit requirements, hard money, flexible. Focus is the asset, the plan, traditional, strict. Excellent credit, tons of documentation needed usually. Loan term, hard money, short, 6 to 24 months, typically. Traditional, long, 15, 30 years. Now, interest rates. Here's the cost of speed. Hard money, higher, usually 7% to 15%, give or take. Traditional, much lower. 3% to 6% maybe for a standard mortgage. Varies, of course.
Yeah, it's a significant difference in rate.
It is. And finally, best for. Hard money is perfect for fix and flips, bridge loans, those really time-sensitive deals where speed is the profit. Traditional loans. Best for your long-term homeowners, people buying their main house, stable income, buy and hold rentals. It's just crucial to see that higher hard money rate as the price you pay for that incredible speed and flexibility, which, like we said, can unlock deals you'd otherwise miss completely.
That comparison makes it crystal clear.
Yeah.
Okay, so given all that, how do you, listening right now, know if a hard money loan is actually right for your specific situation? We kind of put together a quick checklist.
Yep.
Have you run through these points?
Yeah, think of these as questions to ask yourself. First, are you an investor needing fast financing for an opportunity, like right now? Second, is your goal specifically to buy, fix, and flip a property pretty quickly for profit? Third, do you just need a short-term loan for a specific project with a clear end date or exit plan? Fourth, okay, are you genuinely comfortable paying a higher interest rate to get that speed and flexibility? Is the trade-off worth it for this deal? And maybe most importantly, fifth, have you done your homework? Identified a property with real potential, strong resale or rental value, and do you have a solid plan to actually make it happen?
So if you're nodding yes to most of those,
Then yeah, a hard money loan could be a really powerful, really strategic tool for you, something to seriously consider for your investment toolkit.
and it sounds like this isn't just, helping individual investors make money. It has a bigger ripple effect.
That's right. And that's what's fascinating, how these individual loans, these deals, actually create benefits across the whole country, kind of nationwide benefits. Think about it. Hard money lenders empower investors everywhere to move fast, adapt to local market changes. Whether it's a super hot market on the coast or a growing area in the Midwest, financing a flip in California where prices move like crazy, or getting a bridge loan down in Florida to jump on a seasonal rental, or funding new construction out in Texas where things are booming and you needed the money yesterday.
Different needs in different places.
Exactly. This private, responsive funding, it offers a level of flexibility, a speed that traditional lenders often just can't match. And that ultimately helps keep local markets active, dynamic. It contributes to renovations, construction, local economic activity all over the U.S.
So let's wrap this up. What does this all mean for you? We've seen hard money lenders focus mostly on the property's value, not just your credit. That opens doors traditional banks might keep closed. They're short-term loans, great for investments like flips, bridge needs, construction, where speed is critical. Approvals in days. That's huge for time-sensitive deals. Waiting just isn't an option sometimes. And really, investors all over the country benefit from this flexibility and speed. It lets them grab opportunities that would otherwise just slip away.
And given how vital that speed, that adaptability is in real estate today, it really makes you wonder, doesn't it? How might this growing reliance on asset-based fast financing start to reshape our traditional ideas about property ownership, about investment strategy, maybe even about how our communities evolve, not just for the big players, but for individual homeowners, for aspiring entrepreneurs too? How does this change things in the long run?
That is a really powerful thought to chew on and a fantastic challenge for you to think about after this. We really hope this deep dive has given you a much clearer, maybe more nuanced view of hard money lenders and where they fit in today's real estate world. Keep exploring, keep learning, and keep diving deep.